You put $10,000 in your savings account and the bank just made $287 off you. You made $3. That's not a mistake. That's not even the worst part. What I'm about to show you is how the money you're desperately trying to save is actively being weaponized against your financial freedom. And the craziest thing? You signed a 47-page agreement giving them permission to do it. By the end of this video, you'll never look at your bank account the same way, and you'll understand why the wealthiest people barely keep cash in savings at all. Let's start with what you think happens when you deposit money. You imagine your cash sitting safely in a vault with your name on it, right? Earning you a little interest while it waits for you. That's the story. That's the illusion. Here's what actually happens the second your money hits that account. Your bank takes your $10,000 and is legally required to keep only $1,000 of it. That's fractional reserve banking. The other $9,000? They immediately loan it out to someone else at 7% interest for a mortgage, 12% for a car loan, 24% for a credit card. Let me show you the math that'll make your stomach turn. You deposit $10,000 into a high-yield savings account in 2025. The current national average interest rate is 0.46% annually. After 1 year, you've earned a whopping $46. Congratulations. But that same $10,000 the bank loaned out? At just 7% interest, they made $700 in year one, on your money. You did the saving, you delayed gratification, you were responsible, and the bank made 15 times more profit from your discipline than you did. You're not the customer, you're the product. But it gets darker, because that's just layer one. Layer 2 is inflation. While your money sits there safely earning 0.46%, inflation in 2025 is running around 3.2%. Do that math. You're losing 2.74% of your purchasing power every single year. Your $10,000 can buy $9,726 worth of goods after 12 months. You're not saving. You're slowly going broke in the safest way possible. And layer 3? Fees. Overdraft fees that hit when you're $2 short, costing you $35. Maintenance fees if your balance drops below their arbitrary threshold. ATM fees. Wire transfer fees. Insufficient fund fees. American banks collected $35.8 billion in overdraft fees alone in 2024. Let me say that again. $35.8 billion, extracted primarily from people who were already struggling. The system is designed to penalize you for being poor and profit from you when you try to save. Here's what I need to know in the comments. Have you ever been hit with a fee that was larger than the actual mistake you made? Because when we share these stories, we see this isn't individual bad luck. It's systematic extraction. Let me introduce you to Jennifer. She's 29, works in marketing, and she's proud of herself because she finally built up $8,000 in her savings account. It took her 3 years. Then her transmission died, $3,200 to fix. She had to pull it from savings. 2 months later, her cat needed emergency surgery, $1,800. Gone. 6 months after that, her company downsized. She burned through the remaining $3,000 in 8 weeks looking for a new job. She's back to $400 in savings. And she's exhausted. Here's what Jennifer doesn't know and what the banks will never tell you. Her savings account was always a trap designed to keep her liquid but never wealthy. Think about it. They pay you just enough interest to make you feel like you're being responsible. They make it just easy enough to withdraw that when emergencies hit, you pull from savings instead of finding other solutions. And every time you rebuild, you're starting from zero again. You're on a treadmill disguised as a ladder. Meanwhile, here's what happens on the other side of the bank. They take deposits like Jennifer's, and they lock them into long-term loans at high interest rates. They're earning 7%, 12%, 24% on money they're paying you 0.46% for. And they're earning it for 30 years on a mortgage while you might pull your savings out next month. They have all the upside. You have all the risk. They build generational wealth. You rebuild the same $8,000 over and over. So what do? Because I'm not saying don't have savings. I'm saying understand what savings accounts actually are. Wealthy people keep 3 to 6 months of expenses in liquid savings.
That's it. Everything else goes into assets that actually grow faster than inflation.
Here's the difference. Your savings account pays 0.46%. A basic index fund has averaged 10.7% annually over the past 50 years. Even accounting for down years, you're looking at 7 to 8% real growth after inflation. That's 15 to 20 times what your bank is paying you. But what about emergencies, I hear you? That's what that 3 to 6 month cushion is for. Everything beyond that emergency fund isn't savings. It's dormant capital getting destroyed by inflation while making your bank rich. Let me show you the actual numbers. $10,000 in a savings account at 0.46% for 20 years becomes $10,948. After inflation, that's worth about $6,500 in today's dollars. You lost money by being safe. That same $10,000 in an index fund at 8% becomes $46,610. After inflation, roughly $27,800 in real purchasing power. You quadrupled your money by taking moderate, intelligent risk. The banks know this. That's why their executives don't keep millions in savings accounts. They keep it in stocks, bonds, real estate, businesses, assets that work for them instead of against them. Your savings account is where money goes to die slowly. So here's your action plan. Keep your emergency fund liquid, 3 to 6 months of expenses in savings. Everything else? Move it.